Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, January 23rd, 2024. Hope everybody's having a good day out there. Not quite as chilly here in Colorado. It was, had to go out and had a appointment early this morning, and it wasn't not so chill. I mean, yeah, there was like ice frozen on the car and stuff, but yeah, nothing too terrible. And can see more and more of my yard as the days progress, which is very nice. So anyways, hope you're having a good day out there. If you could do me a favor, if you could give me some thumbs up, likes, shares, subscribes, follows, and press the notification bell. You want to know when I go live because, you want to know what happened in the markets, right? Exactly. All right, let's go ahead and get to today's numbers. Dow Jones was down 0.25%, 96 points, closed at 37,905. S&P 500 was up 0.28%. It was in red most of the day, closed at 48.64. NASDAQ finished up 0.43%. Closing at 15,425. Excuse me. The VIX fell 5% today. It's down to 1253. Canada was up 0.53. Brazil was up 1.25, and Mexico was up 1.39%. Over in Europe, Germany was down 0.34. The UK flat, down 0.03. France down 0.34 also. The Netherlands up 0.28, Spain down 1.09%, Italy down 0.35%, Switzerland down 1.12%, and Portugal down 1.06%. Russian exchanges were mixed today. The MOEX up 0.11, RTSI down 0.6. And the Asian markets, the Nikkei was down 0.09%, Australia up 0.51, New Zealand right now is up 0.8. In China, the Shanghai was up 0.53. Shenzhen Component up 1.38%. China A50 down 0.21. DJ Shanghai up 0.61. Hang Seng up 2.63%. And looks like the Taiwan weighted was closed today. All right. So, yeah, it looks like Europe was mostly red. We were red most of the day until it decided to go green. So, anyways. Let's see what's going on in the market recap. S&P 500 inches higher, but industrials and consumer stocks weigh amid mixed earnings. Let's see what that has to say. All right, the S&P 500 experienced a slight uptick on Tuesday, grappling with mixed performance as it weighed gains in the tech sector against weaknesses in industrials and consumer stocks following a range of corporate earnings reports. 3M Company took a significant hit, falling over 11% as weaker than expected full-year guidance overshadowed Q4 results that surpassed analyst estimates. Lockheed Martin Corporation also slipped more than 4% due to a decline in sales in Q4, influenced by a weakness in its rotary and mission systems businesses and its missile and fire control division. I've been getting phone calls like crazy. I don't know about you. I don't know if it's because of, where are these from? Let me put this on Do Not Disturb. There we go. No more distractions. All right, where were we? Okay, fire control business. United Airlines, on the other hand, stood out with a rise of over 6% after reporting better than expected Q4 results driven by robust holiday-related travel demand. The positive quarterly results helped offset guidance projecting a wider than expected loss in Q1, primarily due to the impact of Boeing 737 MAX 9 grounding. General Electric traded just below the flat line, disappointing with its first quarter outlook despite exceeding expectations in fourth quarter earnings. The company's strong demand for parts and services at its jet engine business was overshadowed by a less optimistic Q1 outlook. The home building sector faced a slump impacting consumer stocks, with PulteGroup, Lennar, and D.R. Horton witnessing declines. D.R. Horton reported Q1 earnings just below expectations, attributing the lower figures to margin pressure resulting from price cuts and incentives to attract home buyers. The company anticipates ongoing margin pressure through Q2. Tech stocks contributed to recent gains, especially as investors awaited earnings results from streaming giant Netflix. In addition, Verizon Communications experienced a more than 5% jump following the release of its annual earnings forecast, a range that exceeded expectations, expressing confidence in its growth prospects for 2024. So it's kind of, the porridge is hot, cold, it's kind of in the middle. Nothing's too out of whack right now. All right, moving on. It's an article from Zero Hedge titled "Recession Still Not a Shoo-In as Leading Data Behaves Unusually." All right. Bloomberg macro strategist Simon White discusses the conference board's leading index, which indicates a recessionary trend, marking its 21st consecutive monthly decline. However, White suggests that beneath the surface, the situation is more complex. And while a recession is more likely later in the year, it's not guaranteed. He cautions that the optimism in go-go stocks could leave them exposed in the event of a downturn. The legacy of the pandemic is still affecting reliable data series, complicating the assessment of a recession that would typically be underway. The conference board's leading index comprises 10 indicators, including capital goods orders, weekly hours worked, the yield curve, and stock prices. While the index's decline is historically high, resembling conditions in 1974 and 2008, White notes that the U.S. is not currently in a National Bureau of Economic Research recession, and one doesn't appear imminent. Examining the index's soft market and survey and hard real economic data components reveals that during prior recessions, both soft and hard inputs were contracting simultaneously. In the initial pandemic phase, soft data weakened, but hard data contracted more slowly. Now, soft data is showing signs of weakening, while hard data is slowly recovering. White emphasizes that if soft data continues to weaken while hard data remains weak, a recession becomes more likely. However, if hard data continues to recover while soft data doesn't significantly weaken, a recession might be avoided. This divergence highlights how goods and services economy has been out of sync since the pandemic, preventing a full-blown recession. Stocks, however, are betting on a favorable outcome, potentially leaving the market vulnerable if conditions worsen. So again, the data is all messed up. There's a lot of people out there just don't really know where to go. I mean, I'm kind of hedging on the fact that we're going to have some sort of catastrophe. I mean, it's just, it's an election year. The powers that be don't like Trump too much. So, I wouldn't be shocked if there's a whole new super cold that comes out that tries to scare the dickens out of everybody. But we'll see. All right. Next up, what to expect for the 2024 tax filing season. Let's see what this article had to say. All right. The 2023 tax season, beginning on January 29th, brings changes and considerations for taxpayers. Several credits, including the child tax credit and earned income tax credit, each returned to pre-COVID levels, resulting in reduced benefits for taxpayers. The child tax credit remains at $2,000 per child, and the earned income tax credit has increased for low and moderate income families with a maximum value of $7,430 for families with 3 or more children. Student loan interest deduction is available for those resuming payments, allowing eligible borrowers to deduct up to $2,500 of student loan interest per tax year. However, taxpayers facing forgiven student loan debt may have state liability in states like Arkansas, Indiana, Mississippi, North Carolina, and Wisconsin. And I mean, I haven't looked into this. I'm stepping away from the article, but for anyone who has any loan forgiveness, and I'm speaking from my old days back in the collections and recovery world, someone said, say had a $10,000 credit card debt that they filed bankruptcy on, they get that discharge. They just made $10,000, so they're going to have to pay taxes on that money potentially. So potentially, I haven't read into the tax laws, but in normal circumstances, anytime a debt is discharged or forgiven, you just made that money in income for the year. So, be prepared. You may have a tax bill that you're not aware of. So do your research. I don't have any student loans, so I'm not really worried about it. Reporting requirements for cryptocurrency, NFT transactions, and payments through apps like PayPal and Venmo are crucial. The IRS has delayed the implementation of a lower $600 threshold for third-party payment networks, offering relief to those not engaged in real business. Taxpayers involved in digital asset transactions should ensure proper reporting to avoid penalties. Yeah, because you don't want to piss off the IRS. They need every penny. Unless you're an illegal alien, you can just do whatever you want, come across the border. It doesn't matter. As the work from home trend continues, taxpayers should be aware of that the home office deduction is generally available only to self-employed individuals, not employees. To qualify, the home office must be used exclusively and regularly for business purposes. Tax season concludes on April 15th, with taxpayers in Maine or Massachusetts having until April 17th due to Patriots' Day and Emancipation Day. Those in FEMA-declared disaster relief zones, such as Connecticut taxpayers affected by January storms, have until June 17th to file. Well, if that's any of you people, good. All right. One last article here, just more informational. Comes also from Zero Hedge, titled "Profits Do Not Cause Inflation: Causal Fallacies as Economic Disinformation." All right. The assertion that corporations intentionally raise prices to boost profits, causing recent inflation, is debunked in this analysis. Blaming producers rather than policymakers for economic conditions is a common tendency. The idea that businesses orchestrated price hikes across the entire economy for higher profits is dismissed, considering the impracticality of coordinating countless private entities. The argument is that a follow-the-leader effect led to a widespread increase in prices, creating inflation. That's just not true. However, this theory is deemed absurd as it contradicts the concept of elastic and inelastic demand. The article emphasizes that intentional price hikes would result in reduced consumer spending on other goods and services, contradicting the observed inflation. Data from the Federal Reserve Bank of San Francisco's PCE inflation dispersion metric shows that over 90% of prices in the PCE were rising between July of 2021 and June of 2023. The nearly simultaneous increase in prices across the economy is attributed to a rapid increase in the total money supply, Federal Reserve, aligning with the Federal Reserve's response to the COVID-19 outbreak in 2020. The article rejects the idea that rising prices lead to higher profits because profits for businesses due to various factors, including rising input prices and the lag between different types of price increases. It emphasizes the distinction between nominal and real profits and highlights the fallacy of associating a decrease in the inflation rate with declining prices. Yeah, just because the inflation rate is subsiding doesn't mean the prices are going down. You would have to have actually deflation to have prices go down. Ultimately, the analysis underscores that only a substantial increase in the money supply can cause a rapid rise in overall price levels and associated economic challenges, shifting the blame from businesses to central bankers. Yep, they're the ones who did it. It was the Fed and your government. So you can thank them. They're in Washington. So if you want to go there and tell them how happy you are that you raised all their costs by about 40% over the last couple of years, go ahead. All righty. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.